Right now is a season of joy, but if you don't pay attention to this one aspect, your expenses, the season of joy is going to be quickly, very quickly, the season of sadness, because tax season is the next season.
We were doing our own end of year planning, going through our numbers, because it's opened up a lot of good conversations. Because you look at these numbers consistently, it got us to the end of the year in a good place.
Merry Christmas! And here's your tax bill.
Womp womp.
Womp, womp, womp. What's up, everybody? This is Albert Chou with Stephanie Postles of Mission Daily. Listen, right now is a season of joy. Everyone's having fun. Everyone's thinking about how maybe you got through a tough year. You're having a good time. But if you don't pay attention to this one aspect, your expenses, the season of joy is going to be quickly, very quickly, the season of sadness, because tax season is the next season. So if you're a business owner out there, you're probably trying to figure out what to do with your leftover profits to see if you can spend some of them down. We're going to talk about that today.
Yep, so this is super timely because Albert and I literally just got off a meeting minutes ago where we were doing our own end of year planning, going through our numbers. For anyone who doesn't know or hasn't listened to a previous episode, Albert manages all of our finances for the most part. I handed that off to him, what do you think, 3 years ago maybe? And I never looked back.
You're like, I can't deal with this.
Yeah, I was great. I was like, you know what? I've done all my finance that I need to do in my life. I ran billion-dollar P&Ls. I feel complete. Now you can do this and help me. And it's been really supportive having, someone else actually running it at our company where it's not me, because it's opened up a lot of good conversations in a very non-emotional, not biased way. Albert brings stuff to the table that I wouldn't think about. So today we were going through our end of year books, which we've done, every year now. Every year we do it. And there's a lot of decisions that we have to walk through. And some of these come so easy to Albert that I was like, we need to hop on the mic and go through, Albert's assessments, how he thinks about the company. And there's always key things that we zero in on that I'm like, I think more people should know about this. So that's what I want to do here today is, Albert, have you kind of walk through your AA, which is the good AA of Albert assessments. So.
And not an audit.
We're calling it Albert's assessments because I was using the term audit earlier and he did not like the term audit.
Well, I said an audit is always bad. I've never been.
I don't view it that way.
You're getting an audit, and I'm like, yes. Yes.
I don't know. I
Give
feel
it to
like
me.
I constantly audit every aspect of my life and areas which I'll just change the word. We'll assess. We're assessing things here today on Mission Daily. So whatever makes you feel happier. But first, I want to jump into the first thing that we were going through earlier, which this could be relevant to some businesses, which I want you to kind of talk through.
Yeah.
But we were going through the margins at Mission and how to think about them. And so I want you to speak about how you think about margins for our company and other companies, because you are part of another company as well. Like, how do you think about what the margins should be? If you just high level look at a company's P&L, like when you think this is good or this is bad, if you can walk through that.
Yeah. So every dollar of margin is flexibility. And that's the first most important thing I want everyone to think about is, like, when you have flexibility, it gives you optionality to invest. It gives you optionality to save. It just gives you optionality. So you're looking for the best margin you could possibly make. I live by two philosophies that govern how I make decisions. One is I don't want bad dollars, and two, I don't really want to work that much. And let me explain how that impacts how I think of that things. The first thing is I don't ever want a bad dollar. A bad dollar is a dollar you earn, but it causes outsized stress. If it causes outside stress on your company, whether it's through labor, whether it's through deliverables, whether it's through timelines, or people, it doesn't matter. What it does is it cuts your earnings margin every single time. There is no time when it doesn't cut your earnings margin, and that's where all the stress comes from. And what happens when you get a bad dollar typically is, like in our world, the first version's not good enough. Hey, I want another thumbnail. Hey, I want a new cut. Hey, I cancel a lot. I'm going to cancel all these meetings, so you lose time. These things kill your margin. You can't tell right away because the dollars look the same, because, for example, your payroll looks the same and your cash looks the same, but it's killing you in other ways. Your ability to service other customers, your ability to say yes to other customers, maybe it's employee turnover. So I don't want bad dollars. That's philosophy one. The second philosophy is I actually don't want to do that much. And I know that sounds insane because I end up doing a lot, but I always come in with a goal. I don't want to do that much. And in order to not do that much, I have to have a good business with a good, healthy margin with happy customers, because if those things are true, then there will be less for me to do. So how do I figure those two things out? The first thing I was taught a long time ago, which is your cost of goods sold cannot ever creep over 50%. So this is pretty simple. So like if you're in sales and if you're selling a physical product, just like you were a retailer, you couldn't allow your cost of goods sold to get over 50%. What ends up happening is all the other costs of rent, general and admin, people, payroll, advertising, all that stuff comes out of the next 50%. Well, if you don't have enough pie, that's call it a piece of pie. If you don't have enough pie, either everything else has to tamper down or you'll make no money. You'll work super hard to make not that much. So a grocery store is a great example of this. So most grocery stores need a margin of 30%. And this is because grocery inventory is highly perishable, right? It dies. They can't sell it fast enough, right? So, and then grocery stores are also famously, they only bring down 2% of their bottom line. So think about like a grocery store like Kroger. For it to make, if it sells $100 billion, it'll make $2 billion. But the other way to think of it is like, man, they have to manage their cash at $100 billion level to make $2 billion. Now, you might say $2 billion is worth it, but I'll put it in a different perspective. What if it was only $100,000? Would you ever invest $100,000 to make $2,000? It's like, yeah, that sounds bad. But that's what a grocery store has to do, right? And so they're always trying to squeeze these things out. So when I look at our business is services. So a lot of people out there have services businesses. A lot of people have software-based businesses. Or some people have software-enabled services, like they teach courses. So that's a different ballgame because your cost of goods sold is much lower. But we're a services business. Typically, we need a person to make a podcast, which can only be sold once. It doesn't really get sold again. We aren't in the game of big popular podcasts where we can generate a lot of outsized revenue. Not today, but we don't.
Except for Mission Daily.
Mission Daily does generate advertising revenue, so we can make an episode. Our episodes are fixed costs, and we can actually have cash flow. It varies based upon how popular this show is. So there's a lot of upside in that, right? And I don't like it when I hear people say that they are in the course business and that it's really inexpensive, and then you ask them like, well, how much does it cost you to make a class? And they say, it's like a week of work and stuff like that. And it's like, how much are you paying yourself? Like, well, I'm not paying myself yet. And I was like, but that's your cost. Like that cost is that, and like how much are you selling? It's like, I sold like $300. And I was like, well, unless you're telling me you're worth less than 150, you've lost money. You know what I mean? So that's what I would think about it. Like your time is worth $150 then.
Mm-hmm. Which we actually talked about this in a previous episode after I read that Buy Back Your Time book, which I still highly recommend for anyone to figure out what is your dollar per hour that you are worth. And that right away, I have so many friends who are coaches as well. And I think the same thing. I'm like, yes, your margins are very high because especially if you're putting out a course that you don't have to be a part of as much anymore. Yeah. But it took you 3 months to launch that thing. That's very expensive. Yeah,
it's actually quite expensive. So you have to divide all your earnings by all the time that you've done it. And some people have ascended to a point where, like, of course, it's not a big deal. Mm-hmm. I follow Justin Welch. Justin Welch is all about solopreneurship, and I think he personally does like $5 million a year by himself. So he could spend 80 hours a week, he'll still make money. Yeah. But other people, they don't quite value their time right. I think like if you break it down, you might be like, man, I actually make less than than someone at Home Depot. You know what I mean?
Yeah. But I will say, I forget who I was listening to the other day where they're like, when you're starting off and your dollar per hour that you're able to earn is so low, you might as well try everything and spend your time in ways that, you wouldn't normally. Like as you get older, you probably be like, that's not worth my time. But in those early years, just probably say yes and try everything because
especially when your delta is really small. So a good example would be like if you're in a low income, it's like your annual salary is $30,000 to $36,000. Let's use $36,000. So you're making $3,000 a month. You're working at least 160 hours in the month. Mm-hmm. So then you start realizing, wait, I think I am paying myself $15 to $16 an hour. Mm-hmm. Like you don't even realize it. It's like, oh, that's exactly how much I'm paying myself.
Yep. That's good. Okay.
You know what I mean?
Bring it back to our 50% margins, cost of goods sold. What else should we think about that?
So the quickest math to do. So I always think of things as like, unless something's typically, I always say also, if it's not clearly obvious, it's probably not that big of a deal. So first thing I always look for really quick is my payroll at least half my income. Mm-hmm. It's the quickest thing to look at.
At least or under half?
At max. at max half, because we're a
Yep.
services company. At max half, like it cannot get over half, because we
Yep.
still have long-term liability. We still have rental facility. We still have a lot of software and subscriptions. We have marketing and advertising costs. So these are all costs on top. So if it gets over half, I know this is a hard dollar to make. Right? Is it a bad dollar? Not quite a bad dollar, but it's at least getting harder. Like now it's getting harder, right? If you take your total, so you take your total income divided by your total payroll. Now, if you're also an equipment company where you need a lot of equipment to fulfill the order, you should add in all your equipment costs.
Into that 50% number.
You got it. So like, I also manage the books over at Diesel Jack Media. Diesel Jack Media is, we make TV shows and commercials. Those cameras and lenses, so expensive.
Yeah.
I didn't realize cameras were so expensive. And by the way, did you know if you make an original production, you need production insurance? You actually need production insurance, errors and omissions insurance, because people will sue you because they, hey, you told me it's gonna be in the credit. I'm not in the credit. Like, oh my god.
Yeah, your guys' business is more expensive over there. So yeah,
super expensive.
You have more expenses to think about and depreciation to think about, and just things that we did have at one point, but not as much now. But yeah, so you're saying add that into that 50% number.
The other thing that's crazy about the actual video production business, especially if anything's moving, is equipment loss, which people don't think about. Like I saw a commercial with a Ford pickup truck, and as they were driving, like, you know, they're hanging the camera from a rig, the camera fell off. It was $100,000 camera, dust. So if you're doing, so that's why like the business of making action sports movies, like super expensive, like really expensive stuff. So that's the big challenge is if you're a heavy equipment provider, meaning like we can't make what we are paid to make without this equipment, then you have to roll that in. So roll in your equipment plus your labor. That will tell you if you're at 50% already, you're already cutting it close, because a lot of companies also spend, let's say, 10% on marketing. So let's go backwards. If you want to make 10% margin, you have 10% advertising. Well, now you're left with 30% to handle all your insurance, insurance, liabilities, additional potential costs like rents, general and G&A, all the other things come out of that last 30%. So that's what becomes challenging. The other thing that owners often don't think about is it's not as big of a deal for us, but a lot of middle managers, they don't actually fulfill the work. So they're in that 30. They completely eat that next 30%.
Yep.
They destroy
because they're not
actually.
in the cost of goods sold, because they're not making the work.
They don't make the thing that the people are buying. You know, if they weren't there, now they'll tell you, hey, I'm a people person. I get, you know what I mean? I manage, you know what I mean? You know what I mean? Like imagine Stephanie's my engineer and Jeremy's my engineer. Well, I manage Stephanie and Jeremy. And I'm like, but I thought Stephanie and Jeremy got the requirements from the product team. Yeah, the product team sets the requirements, but I make sure they do it.
Yep.
It's like, but Albert, what do you do? It's like, I'm a people person.
I keep the vibes high.
The vibes high. The vibes are high. Without me, there's a right. And the other thing that people always forget about is cost of sale. Now, usually, cost of sale is the owner. For most small businesses, the cost of sale is the owner, because in a small business, a lot of times people buy the person first, especially services, right? Like if you were a personal accountant, you'd be really hard pressed to sell a single job without meeting the customer. Like it's not going to happen. You know, I mean, you can't have a sales guy that's like skeezy, be like, I'll do your accounting. Well, you'll do the accounting? Well, Stephanie will do the accounting. Can I meet Stephanie? No. Probably won't do a big deal. So cost of sales in there too, because marketing is actually the dollars you spend outside, like on Facebook, billboards, whatever. And so different businesses have different numbers that work, but in general, I think of cost of goods sold plus equipment as part of the cost of goods sold. So payroll plus the equipment necessary and the raw material costs has to be under 50%. If it gets to 50%, you're starting to get there.
Yeah.
That means you're working really hard to make $1.
Yeah. Which I think, I mean, if I think about our year, the reason we're even coming out where we are now, which is pretty good, even though we lost accounts and revenue was down and marketing budgets were cut. I mean, there was a lot of turmoil in the market for like what we sell into this year. And I think because you look at these numbers consistently and you're coming back and pressing me like, we got to lower expenses quickly, we got to change this quickly, because that's your guide, it got us to the end of the year in a good place. So I think constantly keeping track of that, and then, reassessing the work, the people that you have, the expenses you have, the rents that you're paying, whatever it is, and figuring out a quick plan to readjust if you're going above that number.
Yeah, that's how from there you can start looking at the different areas, but that's the first area I look at. It's like, oh, dude, if all this is there, then you can look at other areas. But I always think to myself, you want to manage the biggest thing first, because then that's going to have the most impact.
Yep. Okay, so let's move to one of the biggest things for most companies. So first we talked about, your margins, cost of goods sold, all of that. The second thing that I know we talk about, and we can talk about it here at Mission, we can talk about it for Dieseljack, whatever company it is payroll and employees, and how to think about that, because that usually is the biggest expense for most companies.
100%.
And one thing that I think is interesting that you've had us, or that you and I talk about, or that we do, is thinking about what the workload is that an employee is carrying, which I think is also helpful, because you have a number for what you think, one employee should be carrying on average. So I'd love for you to share your thoughts around that.
Yeah. So a lot of people will try to make reasons why this can't be done. I always think, well, I just need buckets. I just need some guiding. So think of, before you do an assessment, I would tell anyone listening is like, you don't need exact numbers. You need directionality. You just need to know, is it getting bad or is it getting good? Is it staying the same or getting worse? Because your big changes aren't going to be fractional. They're usually, I think, big. So in the services world, typically you're going to think about, well, how many accounts did you service? Accounts, or the dollars they service, right? So it's either got to be accounts or it's got to be the dollars. Usually it's going to be the dollars. It's the easiest number to do. So you take a person or a team of people and you add up, this is how many accounts, paying accounts they serviced across the calendar year. Then, so that's their book. The total dollar value of all the accounts they serviced is a book. I generally only include accounts where they're spending what I believe at least 50% of their time on. You know what I mean? So like, meaning 50% of the time this account asks for something, this person works on it. That's a key. So if you're, you helped out 1 month, I love that. It's great part of being a team player, but it's not how I would go about assessing your carry. So the account has to need you or rely on you for more than 50% of the time, and it's probably your account. All right. So then I take all the personnel of their that service that account, and then I just look at that book. And remember before I said if it's 50, it's high, right?
Wait, 50K.
50%. If it's 50% of the book, you're getting high, right? Because the business needs to clear enough margin to pay for all those other things in between in order to drop a profit at the end of the year.
So let me make sure I understand. So you're saying if the salaries of that group of people is more than 50% of the contract or the revenue that's coming in
on the book that they carry,
or is it profit?
Revenue on the book.
Okay,
it's always against revenue, because profits will come from your allocations.
Okay. So if salaries are above 50% of the revenue coming in, it's getting too high.
Exactly. So if it's $100,000 of salary and it's bringing in 150, it's a problem. If it's $100,000 of salary and it's bringing in 200,000, it's probably a problem. You probably got to watch it. You're not going to go broke, but you should watch. If it's $100,000 bringing $300,000 or more, I don't know. It's not my focus. How about that? Like, you know what I mean? It's like, do I squeeze a little more juice out of there? Like, I don't know. You know what I mean? But it's generally not a problem, because inevitably there's the Bezos way, like I make 3 decisions a day and that's good. It's like, you probably can't solve every single problem that there is, and you can't optimize for everything. That's my belief, but you can definitely, if you hit the big ones, you should be better off. That's the way I think about it.
Yeah, that's good. Okay. So that's super helpful. That was our second one. The third one that I wanted to go through was Runway. This is something that I have been asked a lot of like, how much money do you keep on the books? What do you do if you have profit? How do you think about next year to prepare? And I always say, like, we don't really prepare because we don't know what's going to happen next year, but we do have a number that we stick to. So what is our number of runway of how much money we keep in the bank?
I like 3x payroll, 3x expenses, because your payroll are people payroll's people, right? Like, so I want to know that if I have enough money to carry people for the next 3 months. If you have less than 3 months of payroll and you can't forecast more cash coming in, I mean, that's a challenge. You know you're going to have layoffs are imminent, right? And I just personally prefer to tell someone sooner than later, because I think that's not cool to, if I know it's bad, I'd rather and maybe we can come up with a solution. I get it that 99% of people don't want to hear this news. I get it that 99% of people you tell this to, they don't want to help you. They'll just be like, oh, I'll collect a paycheck and go find another job. But I'm looking for that chance that someone can help me. And sometimes you find it, sometimes you don't. But in general, I've not been hurt more by letting someone know. So I tend to let people know.
Yep. Okay, so 3 months. All right, moving on, because we're moving quickly through some of these prepaying things.
But now this adds up to your tax liability. So now we're here.
Oh, wait, sorry. What? Oh, okay, we're going to prepaying things?
Yeah,
no?
so prepaying things, right? So now you have profits on the year. You kind of forecasted your runway. Now you have a delta. This delta is going to be how much you're taxed on. So you can look at it. So this is where you can start saying, where am I going to make investments next year? And that's where I get fired up about. It's like, hey, I'm going to invest in this. And sometimes straight up, you're not going to have enough money, so you're going to have to make cuts, right? And no one wants to make cuts. So we won't think about cutting things, but we'll think about investing in things, right? Hopefully you have some cash to make an investment. You want to lower your profit number as much as possible so you don't have to pay taxes if that's your goal. If that's not your goal, then I don't know, pay the tax and collect as much as you can. But if you've already paid yourself enough salary and you have a delta of whatever number that is that you have, this is where the coolest time to make investments. And do yourself a favor and don't invest in furniture, which is actually what we were joking about in our previous call. Like, so many companies invest in furniture because it's expensive as shit.
Yep. Yeah.
So they fill their budget. I got new tables.
I mean, at least maybe invest in, I don't know, like a company car, if that is something that you can use with your company. Like, that's when I would think, because you can accelerate the depreciation so quickly on it. It's a larger expense. You'll use it for a while if you need it. I mean, or prepaying things, prepaying insurance.
Yeah, but you're better off buying the car on a loan.
Yeah, that's true.
You know what I mean? Like, you're not better off buying the car up front.
What about the down payment part, though?
Okay. Yeah.
If it's,
yeah. If you need, like, I know, I'm telling you right now, a Ford, shoot, I don't even know what kind of van it is right now, but it's expensive. Like, one of those
Sprinter
Ford,
van?
like, yeah, but Sprinter's Mercedes' brand. Like, we got a Ford, you know what I mean? But it's still like $40,000. It's like $50,000, and it's like a giant tub of metal. I mean, I don't know why it costs so much, but it's expensive. I have one. I pay $538 a month on it. It sucks.
Well, there you go. See? Okay, so prepaying things. What are some expenses that people don't think about that you should maybe? And the only time you would prepay is if you're trying to. Yeah, if you have a surplus. But my thought, I mean, if I think about us this year, we don't have a huge surplus. And so we don't really have that big of a need to prepay, because we actually might want those expenses to fall into next year, where next year I'm betting that we will make more profit. We'll have more revenue coming in next year. And so it might actually be better for us just to push those expenses to next year. Whereas this year, our profits aren't as high as they were in previous years. So I would think about that. But
there you go. The other thing to remember is, like, your tax obligation isn't that much per dollar. I mean, potentially, right? So, like, why accelerate all these costs just so you could save, like corporate tax, 22 cents on the dollar? You know what I mean? Like 22 cents. Like, is that? I wouldn't run into a bad investment to save 22 cents. That sounds stupid.
Yeah.
You know what I mean? So
that's why I only do it if you need those expenses.
Like the furniture. Do not buy the furniture and think that you've done something great for yourself. It's like, well, got me a new chair.
It's got me a new $10,000 love seat. I feel good about it.
Yeah, exactly. Yes, your office needs furniture, but the problem with furniture is you can't sell it, and it doesn't help anyone make your product or service faster. Not that I can tell.
Yeah. Unless you, So okay. So then sometimes you should accelerate some of the expenses. Sometimes you shouldn't. It just kind of depends on if you have a huge tax liability coming to you and you're like,
Yeah.
well, I don't want to just blow it all in taxes, then yeah, finding expenses that you can accelerate, which might be ones that you wouldn't always think of. Like I said, I think the insurance, I think rent payments if you can, I think marketing spend if you can kind of like prepay a balance.
Yep.
I think there's just things like that where you're like, I know I'm going to be spending money on rent for the next 6 months anyways, and so
Prepay it.
prepay it maybe.
There's a lot of software expense also that people tend to prepay, like software sales reps love the end of the year because a lot of people will buy or prepay big chunks of their next year's software subscriptions that they need. So that's a pretty good investment. Other big investments that people make in general, I think about the things I want to invest in my opinion, is more about what it can earn than what it can save. Because, what does Cody Sanchez say? Like the most you can save off of $1 is $1, but the most you can grow off $1 is infinity. Right? So you know what I mean? Like you can't save if we're consistently $1 to $1.5 million a year business. We can't save our way to $2 million. It's not going to happen. So if we want to make $2 million, we have to grow somehow.
Mm-hmm.
So I'd rather invest in something that can grow.
Yep. Yeah. Which we do. I feel like we're pretty good at that. We do it.
Right? Can we save to $2 million if we only make one? Probably not.
No.
That'd be amazing.
Nope. And also that's just, well, you know me. I'm like, that's boring. I'd rather not. I'd rather have some more experiences and things to try out and learn
it can't be done. Like it's just literally
and it
cannot
can't be done. Yeah, that too. It also can't be done. So there's that.
Yeah. If we could get our costs down to even if we got our costs to zero, a team of volunteers does mission, and the business makes 1 to 1.5 million. It's still the most you can make.
Yeah. There's still a ceiling. Yep.
Yeah.
All right. So the last thing I did want to go through, which I think a lot of people get confused, and because everything we've talked about now, I think this will be a good piece to touch on, is the difference between tax deductions, and then tax credits.
Yeah.
What's the difference?
Okay, so you can get both a deduction and a credit, and people are like, I thought those are the same thing. It's like it's not the same thing. So a deduction. So let's go off of 100,000 because it's always the easiest number in my opinion. So let's say you make $100,000 of profit. You are going to get taxed on $100,000 of profit. Every deduction you take there lowers your tax base. So if you have let's say you go back to furniture. Let's say you willy-nilly spend $50,000 in furniture. You will now have $50,000 of profit. So next year you get taxed on $50,000, and that's what you're going to owe for taxes. A credit, there's different programs, and this is where you need to talk to your accountant. But the IRS has different programs where if you're investing in certain categories, whether it's people like the ERC credit, there's an R&D credit if you're trying to build software and technology. It's a credit. And what a credit is a prepayment to next year's tax. So follow along. Is a $50,000 deduction better than a $50,000 credit? Well, let's take a look. I want the credit.
Yeah.
Huh?
I want the credit. Give me that credit.
You want the credit. Trust me, you want the credit. All right. So if you get a $50,000 deduction off of a $100,000 tax, so let's go off $100,000. If you get a $50,000 deduction, your profit goes to $50,000. Corporate tax is around 22%, so you're going to owe $11,000 at the end of the year. So at the end of the year, if you have $50,000, $100,000 of $100,000 of profit, $50,000 of deductions, $50,000 of net profit, multiplied by the 22%, you're going to owe $11,000. So you're out of pocket 11. You have $50,000 of furniture, and you'll have $39,000 in cash.
Yep.
Sounds cool, right?
Sounds okay, but tell me what my credits would be.
All right, so let's go. If you got $50,000 in credits, so you're not going to take a deduction, you will pay taxes on the $100,000. So your taxes are 22%. You're going to be left with $78,000 in the bank, but you'll have a $50,000 credit to apply towards your taxes next year. Now, what did I just say your taxes were? $22,000. So next year, will you pay taxes if you make the same amount of money? No.
No, because
you have a $50,000 credit.
Yeah.
And then the next year, you make another $100,000. Same thing. Will you pay taxes?
No, because you
No.
have leftover.
Because you have leftover. You can carry over your credit. So there's these different programs, R&D, ERC. The ERC was a one-time thing, which, by the way, we have not been granted. It's amazing.
Oh, what the hell? We literally filed for that 2 years ago?
2 years ago.
Jeez.
Well, the IRS actually announced it's pausing. It's like pausing all they're so far. Yeah. Well, we
are getting it. Do not manifest the terrible. Not that it's that big. We're fucking getting it.
So So deductions are through what you spend, and credits are it's like specific categories. And so talk to your accountant about what are the expenses that are credits, because if those are what did we just say? We want to invest in growth. If there's growth projects there, I say do the growth project, because you might be able to deduct the cost and get a credit, because you're going to deduct the cost, meaning like, hey, I have to pay for software. I have to pay for people. I have to pay for, so those are all expenses, but then you get a credit for doing R&D. So that's the kind of thing that you want to be mindful of. They're mutually exclusive. A credit is its own thing. A deduction is its own thing. Sometimes one project can have both deductions and credits, which is, people are like, what?
Yeah,
like, yes,
and that's what we did. So we personally were able to take advantage of the R&D tax credit, which is very helpful to our taxes. And I think you can get both with that. But that's something that, like I said, if I could re-look into that for this year, I would probably take some extra money and invest it in projects that we think could also help the company, but also would be classified as R&D.
Yeah.
Just because it was a helpful tax credit.
Yeah. And one last thing for people who think, just claim it's a R&D. The process for going through credits is not easy. Typically, it's delivered through a third party. You need like a third party to evaluate it. You get interviewed a lot for them, and the evidence you have to show that it is a credit worthy is substantial. So it's not nothing, right? And I think Nick Huber talks about his cost seg for real estate process. Same thing. It's you pay a company to do a cost seg analysis on your real estate, and then they will produce a cost seg or fully accelerated deduction or whatever. I think it's deductions or into depreciation. So they'll like fully accelerate the depreciation of your building, even though you haven't paid for it yet. You know what I mean? You're paying monthly payments. They have, there's ways to do it, and it's for people who make like huge. Typically, what will happen is people have huge years in real estate because they sell a building. So if you sell $1 million building, or you make $1 million on a building sale, you pay taxes on $1 million. So if they took 10% of that, $100,000, and bought another building at $1 million, and then did a cost seg analysis on it, and got to pull all the depreciation forward, they would make zero on the year.
Yep. Yeah. Real estate's
even though they
wild
paid
space.
10%.
Yep.
Because in real life, they have $900,000 in the bank.
Yep.
You know what I mean?
Yeah. All right.
So there's all these there's the credits. Definitely talk to an accountant on that, because it's not easy, and it almost always involves a third party. Like I can't think of a single credit you can take that the IRS will just grant you without having a third party certified company say that you have a credit. You know what I mean?
Yeah. No.
Like,
Yeah.
we've not encountered that.
Yeah, the R&D tax credit was really intense. I mean, the ERC one, same thing, and we had someone else do that for us. I'm looking at some of the other tax credits you can get, like empowerment zone credits, where you can get $3,000 per employee if you hire people in like a distressed area.
Yep,
I'm
opportunity zones.
Yeah, I'm like, that's a great credit, and you probably have a lot of proving that this person lives here, and here's their salary, and I also work from there. So, yeah, got to do your homework, but I do think that if you are able to get these, they're great, and even preferred over,
Oh, they're 100% preferred, because the deduction, you only save 22% of what you have deducted. Mm-hmm. People forget that. A credit is 100% of the credit.
Yep.
You get to save 100% of the credit. That's a big difference to me.
Yep, I'd say so. All right. Any final end of year things that you think I missed that we should go through?
Yeah, for sure. If you're, I don't know if you missed, but if I were just to tell anyone who's a small business owner is trying to, a lot of it depends on your goals, of course. That's always the first caveat. But I was thinking to myself, hey, for me, I always wanted to be easier. So I think to myself, hey, where will I invest my money the big thing that Stephanie and I talked about is, and we agree on, is you should, once you've right sized your team, you have to invest in something that can grow your business. It is foolish, not foolish, but you just can't save your way to more. Like, you can only save what you can save. You just can't. You can't grow savings. Now, if you're telling me you want to invest in something, fine. But at the end of the day, there should be an investment somewhere, and that's I think a universal one, no matter what business you're in.
Yep. Yeah. And I think we can have a whole other episode thinking about how we think about investing in what, because I know some years we've done like riskier investments and some maybe paid off and some didn't. And that's the name of the game. It's like, okay, and move on. But figuring out like what that strategy looks like and what are the big bets you're making, what's the upside potential that you could have from that one investment, I think is always a good end of year thing to think about for the next year too.
Yeah. And if it's incremental, even if it's incremental, I don't know, but you should be investing in growth for sure.
Yep.
I think.
Yep, I agree. All right. Well, I hope this end of year Albert assessment episode helped y'all listening. Let us know what you think. Also, make sure you subscribe to the podcast and give us a rating and review. And thanks for tuning in.